Hi, welcome back to another edition of Lipper's Fund Flows Insight. My name is Tom Rosine. Thanks for joining me today. I'm going to be reporting flows for the week ended Wednesday, January 14th, 2015. You know, we saw the conventional fund business actually shed about $5.2 billion. And this is after actually having some pretty good news on Friday. Non-farm payrolls came in at 252,000. That's, way above expectations. And that the actual unemployment rate dropped. However, I think people decided to focus kind of on the negative. And that's we saw wage prices actually go down. And with wages declining, the attacks on France that we saw, over the latter part of the week, really, I think, put a dour mood in the market. In addition, people have been very concerned about falling oil prices and that there's going to be a global fallout, maybe even a global recession or depression that occurs from this, kind of phenomena of dollars, the oil dropping below the $2 mark. And certainly we've seen a little bit of uptick over the last day or so, but people are still concerned that there's some global issues out there as far as global growth goes and worried about a recession. And that has caused the VIX to skyrocket up to about 21.6 on Wednesday. It's actually been a little bit higher over Thursday and Friday as well, but certainly I think it's taken some investors off guard. Flows were not all that bad. Let's go ahead and take a look at how our macro groups panned out. Actually, we saw equity funds lose only about $400 million, so it wasn't really that bad of a week at all. Taxable bond funds took in 2.9 as investors, I think, ducked for cover and went after some of the safe haven plays. Muni bond funds maybe on a safe haven play as well, so about $600 million in net new money come into their coffers. And the big outflows, kind of a head scratcher if you're concerned. You'd think people would be putting money back into cash, but we saw outflows of about $8.3 billion out of money market funds, certainly the biggest portion of our outflows that we saw for the week. Well, let's see how that panned out on a group-by-group basis. Let's first take a look at equity funds. Equity funds actually saw a minor decline of 0.08% for the week, so it wasn't that big. Last week, I think Pat told you about a 1.29% decline, somewhere in that area anyways. But we really haven't, with all the doldrums, with all the panic that everybody's having in the newspapers, in the magazines, basically we really haven't seen that much as far as negative returns go on a week-by-week basis. So I think it was a little bit overblown. For the third consecutive week, however, we actually saw outflows about $0.4 billion, as I told you before. But how this broke out is domestic equity funds saw only about $40 million of an outflows, whereas if we take a look at non-domestic equity funds for the seventh week in 8, we saw some pretty big outflows, about $0.4 billion in outflows for that group. And how that broke out, if we really take a look at it on the domestic side, investors shunned large cap funds, about $0.4 billion in outflows, and then we saw the mid cap funds suffer about $0.3 billion in outflows. So it wasn't really that bad. And real estate funds actually saw inflows of about $200 million. So it was again not as bad a story as people have been putting in the mainline press. Obviously, we're seeing a hiccup. People are kind of pausing, but we're not seeing a rapid run for the doors. On the non-domestic side, international equity funds saw outflows, about $500 million of money leaving their coffers. But interesting enough, even though we've had kind of a panic of what's happening to Russia and a lot of the South American countries with oil and also some of the oil-producing countries with that big decline, emerging markets actually took in money, not a lot. So what we did is I added emerging markets, Japanese funds, and Pacific ex-Japan funds together, and they took in about $90 million. So really not that big of a deal, but ironic that we have this fear of a global depression or recession happening, and people putting money back to work in kind of the suspect areas. Let's take a look at our equity ETF flows. For the second consecutive week, we've seen outflows, $3.6 billion this time. At the top of the group, though, as we saw on inflows, healthcare select sector spider funds took in about a little bit less than $1 billion. And then we take a look at U.S. oil fund. People, again, we've seen a little bit of an uptick. People anticipating that, I think. $400 million of net new money come into that group. And iShares Core S&P 500 saw about $300 million in net new money come into theirs. At the bottom of this, as we usually see when we have some big steam let off of markets, the spider S&P 500 SPY lost about $6.5 billion. So that was the big lion's share there. But really, again, not that much to talk about. People just making moves, and the big beginning of January kind of being a rough move after having 5 consecutive years of upside performance. I think people are just scared and kind of walking away from it a little bit to see what happens in fourth quarter earnings, which has already started. And forgot to mention Alcoa actually did very well as far as coming in with the kind of bellwether type of report and certainly strong returns. But again, investors were a little bit scared this week because of all the political stuff that's going on. Let's take a look at our fixed income funds and see what happened in that group. For the third week in 4, we saw inflows, $2.9 billion this time. And for the first week in 3, we saw actually plus side performance, about 0.20%. What took in the majority of the money was corporate investment grade debt funds, and that's about $1.6 billion net new money coming to their coffers, the second consecutive week of inflows. But ironically, you remember we had some outflows out of the equity funds. High yield funds actually took in about $300 million. And that's a little bit of a head scratcher because usually we have sympathetic moves with equities and high yield funds. But apparently some people are actually just looking for yield. And this is, by the way, this is the first week in 8 that we've seen inflows into this group. Loan participation funds basically lost money again, $600 million, 27th consecutive week. So obviously the Fed coming out with mixed messages of when they're going to raise. A lot of people are just betting that it's getting longer and longer and longer away as far as raises go. Some people are saying June, some people are saying September. Now some people are even talking about it might be waiting until 2016 to do that. So let's take a look now at our ETF group and see what happened there. Basically for ETF fixed income funds, we saw about $1.4 billion of net new money come into their coffers. It's the first week in 3 we've seen positive inflows, and iShares 20 plus Treasury bond ETF Tilt basically saw the lion's share of the money come in. $452 million of money coming into that group. But then if we take a look at the next 3, we really have that high yield phenomenon we saw on the open end side as well. So people either were doing corporate investment grade or high yield debt and bringing money into there. So there is a theme there, a constant theme. At the bottom of the group, and this is in line with what we saw with the loan participation, iShares floating rate bond lost about $283 million as people got out of that ETF as well. Well, let's take a look now at our Muni Bond Fund group. And our Muni Bond Fund group might have been just a good old flight to safety with the idea that treasuries and munis actually have some correlation there. But that we saw about $560 million coming. That's the second week in a row that we've seen inflows. It's the third consecutive week that we've seen positive returns, this time to the tune of 0.39%. For a weekly return, that's actually fairly strong. But how it broke out is we saw national munis take in $451 million. This is the 12th consecutive week that they've taken in money. But if we take a look at it, that means that the single states actually took in money, and that's where we've been seeing, some of the outflows, as people haven't been voting the single states as much as they've been voting toward the national muni. Well, that brings us to our money market classification. Again, I told you that's where it saw the biggest outflows, about $8.3 billion. It's the second consecutive week they've seen outflows, and again, a little bit of a head scratcher because if people are diving for safety, why would they be pulling money out? Well, it could be that it's a year end. People put money away so they can put money to work, either to fund 401ks and the like. And so maybe corporate treasurers were actually moving money this time. This is how it broke out. Taxable money market funds saw about $6 billion in outflows, and how that broke out is institutional investors only saw about $600 million in outflows, so that wasn't the big thing. And then the retail investor took about $5.4 billion in outflows, so again, a little bit of a head scratcher. Tax-exempt money market funds, however, saw about $2.3 billion in outflows. So that kind of brings us to the end of our conversation. But when we're taking a look at this, we look at the kind of the current events to see if they have any immediate influence. And 2 things came out that were kind of alarming on Thursday and Friday. First of all, we saw yesterday industrial production drop by about 0.2%, and that's going to get some people kind of on the fear side. The VIX, moving up again. And the reason is we've seen retail sales and now industrial production kind of on the downside, and I think that concerns people. In addition, we had, of course, Switzerland depeg its currency, the Swiss franc, from the euro, and that was a vote against popularity of the euro, and maybe kind of sent kind of a chill through the markets. But as we look today, actually Germany's market was up. Looks like the U.S. market is up as well. So. If you want to do a deeper dive and check into the stuff that I was talking about this week, but maybe go into a deeper area, into a different classification, you can go to www.lipperusfundflows.com. If not, you can come and visit us next week and find out what these impacts of this new news is, and we'll have on our fund flows when analysts will talk about the fund flows in this situation for the week. Thanks for joining me. My name's Tom Rosine, wishing you the best in your wealth planning and creation.